Hi, this is Brian from KineticTrader.com, and I thought I'd do a quick video on options delta because it's easier to explain it hopefully on video than to try and write it all out. So options delta. So for those that are new to options, understand that delta is what they call an option Greek, and it measures how much the option is going to move relative to a move in the underlying stock. So if I have a stock here with a current market price of $111 and an at the money option, which would be closest strike price would be $110 or 110, you'd see the call has a delta of 0.69 and the put has a 0.31 because it is slightly in the money on the call. So what that means is it's going to move 69 cents for the 110 call with every dollar move in the underlying stock. Now the farther in the money the call option is, so if you move all the way up to say an 85 strike, and remember for those that are new, call option benefits with the increase in the stock price, you're looking at a 1 delta. So it's going to move dollar for dollar with the move in the underlying stock. If you are bearish and you own a far in the money put, which would be say all the way down here at say a 140 put, it's got a negative 1 delta, so it's going to move dollar for dollar with an underlying down or decrease in the stock price. Something to realize though is that delta will increase as the option becomes more in the money, and as it gets more in the money, you will see the time value priced into the option turn into intrinsic value or just real value relative to the strike price. So just means that if it gets more in the money, the market's going to price in the fact that it has a higher probability of expiring in the money by expiration. And as you do get closer to expiration, you will see delta start to really move, especially if you're in the money option. So it's something to be worried about. If you're short an option that becomes in the money and you're getting into expiration, you will see delta increase quite rapidly. And if you don't want the stock to move farther in the money on you, you can really get impacted if you're short an option that moves in the money. So it's something to pay attention to. Although if you want, say, buy a long-term call and it's slightly out of the money or it's slightly in the money and you think the stock is going to move up, you could, as a cheaper way, just buy a slightly in the money call, and then if the stock moves up and towards expiration and has a higher likelihood of expiring in the money, you will see delta increase pretty good clip, and therefore it might be a cheaper version of owning that option. So for income traders, a lot of people like to reference delta if they have a portfolio of different option positions to try and keep their overall delta between their positions neutral or near zero, so that they're not weighted towards a positive or negative delta, and more focus on just collecting time decay and income on their positions versus being exposed to a move in the underlying stocks that they own options on or the underlying overall market. And something else on delta is to pay attention to implied volatility, because it really can have an effect on delta. A higher implied volatility adds time value and a lower implied volatility takes it away. So an increase in implied volatility can increase the deltas on out of the money options, and it can decrease delta on in the money options. And essentially what that means is that if the volatility increases, the market is going to price in the delta on those out of the money options, a higher likelihood that they could potentially move in the money because the volatility on the underlying stock is moving around more. So those out of the money options could move in the money, and therefore the delta will increase. If you have an in the money option and the implied volatility increases, you might see a decrease in those deltas because there is a potential now for those in the money options to actually maybe move out of the money now that the stock's moving about a lot. So it's just something to pay attention to, especially if you're going long an option farther out of the money, paying attention to implied volatility, because if you bought a high implied volatility option and you saw it decrease in implied volatility, you really could see an impact to the premium on those prices. And so that's why you hear a lot of people maybe lose money on options. It's because they're playing with options that are out of the money and they really don't have an understanding of what affects pricing on those options. So hopefully that made sense on all that, and that is a summary of delta. Reference my website for some notes on this. Thank you.